This video is to give you an example of how to get the information and calculate free cash flows to equity for purposes of doing valuations. For starters, the appropriate cash flows to use for any sort of valuation of equity are the cash flows that the equity owners are entitled to, and we call those free cash flows to equity. To get those, you would basically start with the net income of the company. You add back any non-cash charges, since those aren't real cash and you want to deal in cash. So that would usually be depreciation, amortization. You're going to subtract any net change in capital investment, so investments that you made less any money you received from, say, selling some investments. And you subtract that because obviously that's no longer available to equity. And then you're going to subtract from that any money that you put into working capital rather than freeing it up for equity. And then you're going to add back any additional borrowing that you've done on a net basis. So that would be money you've raised less any principal that you've paid out. And that we think in terms of, from a financial standpoint for corporations, that when a company borrows money, it's actually the equity investors that are borrowing the money and then authorizing the company to use it. But technically, until it's used for investments, it's available to them. This is that separate video I've put together. So the starting point for this, we need to sort of put together a spreadsheet and start filling out values. And I've done that. Let me drag that over here. So again, going back to the explanation, free cash flows to equity. In this case, this is for the year ended October 1st, 2016, millions of dollars. I got this information from going to the Disney website and pulling down their most recent quarterly report, and that is here. I'm going to try and do a little something and sort of split screen these things so that you can see both of these. Let's see if this will work. Squeeze that down a little bit so we can put it over here. So the first thing we need is net income. My experience with most reports is that you can just go down to the very bottom. The financials are almost very near the bottom, so I usually start at the bottom and work my way back up. There are a number of places you can get net income. I like working off of the cash flow statement because a lot of other things come from that, but you can get it from the income statement. Here, the net income for the year ended October 1st, 2016 is 9790. If you go look up here, you see that's 9790 and goes down to 9391 because you deduct out some non-controlling interest. I'm going to use the 9391. That's a complexity in the real world. I don't want to spend a lot of time explaining it here, but it has to do with when you consolidate affiliates, not affiliates. As far as the depreciation, you can see it doesn't show up anywhere here, even though we know that it's usually in the income statement. It's almost always broken out in more detail in the cash flow statement. So here we go, 9527. You see that over there? And that's a positive number that we put in there. Sorry, that slid over on me. It's a positive number because we're adding it. Capital investments, you can pretty much usually take just the net investing activity, and it's a negative number here because we're spending it, so it reduces amounts available for equity. The next thing we need is the net change in non-cash working capital. There's not a real easy direct place to get that, although you could probably go through and sort of deduce it from some of these other numbers somewhat. But what I do is basically go back up to the balance sheet in this case, and you look under current assets, So that's the asset side of it. And I did not do that right. That's okay. I'll show you how to do it. And we want the cash and cash equivalents to be excluded. We don't want that number. And so we want the receivables, the inventories, television costs, deferred income, other current assets. And we want the change in those. So we're going to put those in there. And again, it's this year minus last year. So you can see that I've sort of just put this year minus last year, and this formula is just taking the difference between those. Okay. Now, so working capital, the amounts that you have in receivables or assets are positive numbers in working capital. They are negative numbers in liabilities, because as the liabilities, if you change that and make it less, then that means that there's less working capital tied up there. For that, we need the current liabilities without the current portion of borrowing. And so here we would put I'm going to slide that over just a little bit. We're going to put the AP. And again, the amounts there, 9130, 7844. It just takes the difference of that, but we're going to make that a negative difference. So we'll put a minus in front of that. And then we're going to take not the current portion of borrowing, but we're going to take the unearned royalties and other advances, and we'll just call that other liabilities. Just like we'll go change this one to other assets. Other liabilities, so if you go look at this again, 4025, 3927, and make sure it changed it right. Yeah, so that's a negative. Okay, so those being negative are basically saying that your liabilities went up, you borrowed more, and therefore your working capital went down. And so that changes our change in non-working capital from being, before it was a minus 133, it's gone up. So in fact, we've added some cash here as a result of that. Last thing we need to do is add net borrowing. I've gone over here and done that. And again, you can go to the balance sheet for that and just look down at the from the liabilities. We would look at sorry, I'm just looking at. I'm actually going to go down to the cash flow statement because it's a little bit cleaner there. It talks in terms of cash that we received from these. So from a commercial paper standpoint, we paid out cash this year. So it's like negative borrowing. We paid it back in, so that's a negative number. In terms of total borrowing, which would include short-term and long-term, so that's good. We had basically $6 billion that we borrowed. In terms of reduction in borrowing, so that would be principal that we've paid usually, or some sort of refinancing. We paid out 2205, and so that's 2940 when you add it all up. Put it in there. It comes over here again. This comes in as a positive number because you're adding it back. This comes in as a positive number because this is negative, but you're subtracting it, right? So I got a negative whatever that amount is. So the idea here is that this actually decreased our working capital, which would free up money for equity. So we would expect it to be a positive number over here. And the total we get is 10617. This is in millions, so that's 10,617,000,000 in free cash flows to equity that we get from doing this. And so I'm going to go edit my little PowerPoint here to reflect my error. 10617 is what I need. 10.617. Oh, sorry about that. And save it. And that's all I got. You might use this for class in a number of different ways, so this is just a nice little handy video for you. Thank you guys.